Hi everybody, the objective of a commercial bank is simple, right? To maximize profit. The reason why? There are shareholders. You want to keep your shareholders happy. They are the ones that own the business. Without them, there wouldn't be a commercial bank. So if you're making more profit, then they get higher dividends, they're very happy. Now, shareholders are very important because you as a commercial bank manager, right, you are liable to your shareholders. If you're making loads of profit, you're going to keep your job. If you don't, you might lose your job. If you're making loads of profit, you might get a higher salary, great for you. You might get more perks, great for you. That all is going to be determined by the shareholders. So profit maximization is very important for that reason, because you've got shareholders. How can you make loads of profit? Well, as a commercial bank, borrowing short-term, which is low interest, and lending long-term, which is much higher interest, gives you a great profit margin. Fantastic news. So for example, borrowing money in the money markets and lending in terms of mortgages, in terms of longer term loans, for example, in terms of longer term investments, all great news to maximize your profit. But also by taking more risk, that's offering less secured loans. So for example, offering loans to those who are slightly dodgy, maybe unemployment is likely in the next 6 months or something, maybe not. Maybe they're not putting down much of a deposit, more risk there. Maybe their financial history isn't as great, so you're taking more risk. By taking more risk, you can charge a higher interest. Another way to take more risk is by issuing loans that are not backed by anything. So you offer loans, and if those loans go bad, they go bad. You as a bank don't take anything back. That means you can charge a higher interest to maximize profit. Alright, so that's how you can profit maximize. Great, you keep shareholders happy, managers like it too. Workers might like it, they might get a higher salary themselves. Great news, right? But doing this is dangerous. The risk of bank failure is much higher. And bank failure is not in the commercial bank's best interest at all. Obviously, shareholders lose all their money. That's a bad thing for them. Managers will lose their jobs, lose their incomes. Bad news for them. Of course, they don't want bank failure. But there are deeper consequences too. For society, that's not a good thing. Systemic risk, we talked about this before, didn't we, in my previous video? How if the bank fails, it's not just them that will fail, it might be another bank that fails, and then another bank that fails, and then another bank that fails. Basically, the whole financial system can come down if one bank fails. That's bad, that's systemic risk, and the greater chance of total financial system collapse. As we know in the UK, the financial industry is the backbone of our economy. If there is financial collapse and the whole financial system goes completely into collapse, there is going to be a deep financial crisis and recession in the country. And with that, we know there'll be lost incomes, not just for those who work in the industry, but generally throughout the economy. There'll be high unemployment again throughout the economy, lost output, all bad news, completely bad news. And also there is the cost of bank bailouts, right? So the taxpayer having to bear the brunt of bank bailouts if the government, if the Bank of England decide that actually this bank can't fail. The taxpayer bears the brunt. I mean, look at what happened post-2008 and how the UK taxpayer is bearing the brunt of all these bank bailouts. Terrible news. But also it's not in the best interests of the commercial bank themselves, because if their bank is bailed out, there'll be tight regulations thereafter. There'll be tight conditions to that bailout. If the taxpayer is in control of the bank, well then managers don't have as much control, they don't have as much say as to how the bank can actually run. So it's not in the best interests of shareholders and those who work in the bank themselves if there is bank failure. Remember, there are two ways in which a commercial bank can fail. There could be a liquidity crisis where there is not enough short-term liquid assets that the commercial bank has to meet its short-term liabilities. Liquidity crisis, a bank run. The second way is that a commercial bank can go insolvent if they don't have enough capital to offset any losses in asset value. So any loans that go bad, if there is not enough capital to offset those fall in asset values, then there is insolvency. Liabilities will be greater than assets, not sustainable, and you see bank failure that way. So that means for a commercial bank, they've got to balance their objective of profit maximization with liquidity. Holding more cash, for example, holding more reserves at the Bank of England, lending more in the interbank market, for example. Now those three things will ensure there is liquidity to avoid a bank run, great, to prevent the risk of bank failure, fine, but they are not as profitable. So for example, reserves at the Bank of England, you'll only get bank rate. For example, if you lend in the interbank market, you only get LIBOR, and LIBOR, the London interbank offer rate, tends to follow the bank rate, which will be much lower than if you offer loans, longer term loans, which give you a much higher interest rate. So you sacrifice a bit of profit to keep short-term liquidity, to make sure you can meet your short-term liabilities to prevent a bank run. Fine. Security is another thing a commercial bank must be aware of. That is managing risk to avoid insolvency. Now, security, again, issuing secure loans is not the most profitable for a bank. So for example, issuing loans to very, very safe lenders, you can't charge a very high interest rate there. For example, issuing more loans that are backed by something, again, reduces the interest rate you can charge there. Now, that's all well and good doing that, but it reduces your profit-making potential. You can't make as high profits, but it means you are safer. It means you have less loans that are likely to go bad. It means that you don't need to hold as much capital, therefore. Because your loans are less likely to go bad, you're not worried about capital to offset those loans. And you've only got maybe a few loans that you think will go bad, in which case you've got enough capital to offset those loans if they go bad. So that's what security is all about, managing risk there and reducing the chance of becoming insolvent and therefore bank failure. But as you can see, for both, to keep liquidity, to make sure you're more secure and you're managing risk, you have to sacrifice a bit of profit as a commercial bank, which means it's not all about gung-ho profit maximization. Bank failure is scary. Therefore, having enough liquidity, being secure enough with the loans that you offer is in the bank's best interest, and that means sacrificing a bit of profit. And that means the conclusion is that for a commercial bank, having balance in the portfolio of assets that they hold is in the best long-term interest of the bank, but also is in the best long-term interest of society, given these consequences of bank failure. Thank you so much for watching, guys. Hopefully that all makes sense. I'll see you all in the next video.